Hello students, I hope all of you are doing well and in good health. Uh, Sorry for this arrangement where we have to deliver, or in fact we are forced to deliver lectures through recordings. And this is, as you know, due to the unprecedented situation facing Norway and the rest of the world. So first of all, let me start by apologizing for any inconveniences caused, and and also thank you for your cooperation. Um, I'd like to assure you that we are trying to work on a situation. The university is trying to provide an alternative situation where two-way communication is possible. So as and when that becomes available, we'll try to move on to an online form of delivery where you can also participate live and ask any questions or seek any clarifications as we proceed with the lecture. But for now, probably this lecture and lecture 6 both will be delivered through recordings. So each recording will be delivered in parts. So just to give you more time to go through the lecture at your own pace. So please go through the recordings. And if you have any questions, you're more than welcome to send me an email, and I'll try to respond as quickly as possible. So shall we get started? Great, thank you. So this is lecture 5, and this was supposed to be delivered on March 13th, which is last Friday. So this lecture sort of moves away more towards the realm of financial innovation. So in the last lecture, let's say in the last 3 lectures, we focused on the core essentials like what financial markets are, what financial intermediaries are, what purposes they, what is their utility, and we looked at some of the key functions that they provide, some of the key benefits that they provide, mainly in terms of resolving information asymmetries, whether that's pre-contract adverse selection or duplicated screening or post-contractual moral hazard. In the last lecture, we moved towards one of the most widespread and perhaps the most earliest forms of financial innovation, which is securitization. Now, securitization, as you might recall from the last lecture, was meant to allow banks to create more liquidity on their balance sheets, enable them to make more profits. And it did work wonders for the banks. It was applied first to the housing market and later on applied to other forms of asset classes which banks indulge in. And it allowed banks to reap in huge amounts of profits. But the problem was, it also brought in a lot of risk into the system. And in fact, it was one of the major factors that precipitated the financial crisis in 2007. We saw that in great detail in the last lecture. Now, there have been other attempts, other unique ways in which financial intermediation is being changed, it's being evolved. And 2 forms which we'll learn today is the notion of disintermediation and also the notion of reintermediation. Okay, we'll see what these are, what the differences between them are, and how they are trying to change, how both these aspects, disintermediation and reintermediation, are trying to change or revamp the existing ways in which financial intermediaries operate. And as part of that, we'll look at something very unique called peer-to-peer lending. So this is peer-to-peer lending, or P2P lending, is one of the most widespread forms of, I would say, well, you can either call it disintermediation or reintermediation, depending on the kind of platform you're dealing with. But peer-to-peer lending is a new form of financial intermediation, and we'll see how it operates. Lastly, we'll try to compare the kind of benefits that P2P platforms provide vis-a-vis banks, and we'll see whether banks are better at screening potential borrowers or whether P2P platforms do a better job at that. Okay, and we'll study that through some comparative statics analysis using a couple of models of screening. Okay, now let's start with the first part, which this video will deal with. So we'll look at some recent trends in financial innovation. Okay, so you are quite aware that technology has transformed every aspect of our lives, right? If you look at the impact of technology on our lives in the last 150 odd years, you'll see that it has impacted every element of our life. It has introduced cars to us, it has introduced electricity, and technology has gone so far as today it is changing our lives by introducing more and more computing, more and more information, more and more digital technologies into our lives. Okay. In addition to providing different, let's say, in addition to revamping the way we live our lives, what technology has also done alongside is it has brought down the cost of doing our things, whether that's in terms of cars. So if you just look at cars, the way we use cars for transportation, earlier cars were introduced to allow us to travel from place A to place B, and that in itself was a big technology. And Henry Ford brought that to the masses by bringing about assembly production of cars. Right? If you're not aware of that, please read Wikipedia page on Henry Ford. Now, if you look at the rapid progress of how technology has changed the way we use cars for transportation, what has happened? Having car is still quite an expensive affair. You have to pay for the purchase of the car, you have to pay for its maintenance, it bears some fuel costs, and also insurance expenses. So owning cars is not that cheap at the end of the day. But what has the introduction of digital technologies, the internet or computing, changed the way we rely on cars? Today, you have apps like Uber, which allow us to order a means of transportation at the click of a button. And on top of that, our cost to access transportation has come down significantly, right? So today, it costs very little to travel from place A to place B in a cab. How is that possible? That's because of technology. So the underlying notion here I want to bring about is that technology has not only improved our lives by making it more efficient, but in general, it has made it more cheap. That when you compare the impact of technology in all walks of life and also apply that to financial intermediation, you'll be surprised to know that the cost of financial intermediation, let's say the unit cost of financial intermediation in general, has more or less remained the same, which is 2%. And it has been to 2% since the last 150 years. And this was documented by Thomas Philippon in one of his famous papers from 2014. What does this suggest? While technology has revamped every walk of life, it hasn't necessarily been able to revamp financial intermediation, which is rather surprising, right? And the problems such as these in financial markets have actually spurred a new wave of innovation. New entrepreneurs, new creative thinkers, people with computing skills, all these guys have got together and have attempted to create a new wave of financial services, new wave of financial products, or even institutions or markets that seek to provide a better financial service to consumers. Okay, and this has spurred this thing called the fintech industry, the fintech revolution, which is essentially technologically enabled financial innovation that seeks to create new business models, new products or processes that have a significant effect on the way financial markets and institutions operate. What is the ultimate objective of fintech or financial technology? So fintech is nothing but short for financial technology. But what is its ultimate objective? Well, Richard Thakur, one of the best known names in financial intermediation, he's a professor in the US, says that fintech has two main objectives. One is obviously to provide a lower, let's say a cheaper access to financial services and products. But more importantly, fintech serves to resolve some of the frictions affecting financial markets. Okay, we'll see how financial innovation or fintech in general seeks to achieve that through different examples. Now, Thakur says that fintech operates in four functional areas. So the first one is obviously financing in general. So whether that's in terms of providing loans or keeping deposits or allowing firms and individuals to raise financing in general, fintech has a major presence in that area. Second area where fintech is very active is in the payment sector. And that includes digital solutions, let's say your cards, credit cards and debit cards. That's one aspect of payment. Then you have digital solutions like paying through your mobile phones, and more recently, the advent of cryptocurrencies. So all that comes under fintech. Next is about allowing people to make investments and also trade on different financial securities. That's another area where fintech is quite active. So, for example, you have this new wave of robo-advisors which offer advice to people on the fly and in a way that human advisors cannot provide. So this is one aspect where fintech is quite active. This is such as in the area of robo-advisory, and that falls under the third category. And another major market where fintech is quite active within the realm of financial intermediation is in the insurance sector. Now, we won't talk a lot about how fintech affects insurance sector, but take me for the word that insurance is another major area where fintech is quite active, whether that's in terms of assessing risk, analyzing claims from different customers, processing those claims, verifying the validity of those claims. So let's say you buy an insurance product for your airline ticket. How does an insurance company verify whether your flight actually got delayed or cancelled? Now, a lot of fintech firms are active in trying to validate those kind of claims, okay, by sourcing information from different sources. What are the main objectives of all these activities within the fintech sector? Well, obviously, one is to improve economies of scale, okay, whether that's in terms of providing cheaper services, capturing new markets, replacing existing financial intermediaries. One of the key objectives is to provide or achieve better economies of scale. Second thing is there is an explosion in the amount of information that is available. And traditional financial intermediaries like banks don't really have the necessary expertise to make any sense of that information. And that's one area where fintech firms are quite actively exploring. Third is obviously, what are financial markets? We have learned that financial markets are nothing but matching markets, where transacting parties can seek out each other and exchange capital. Well, fintech fintech attempts to reduce the search costs involved in involved in this matching process. And what about the last part? It is obviously to reduce and streamline the process of verification. If you go to a bank will demand a lot of paperwork from you in order to guarantee or in order to verify your claim, in order to make sure that you're creditworthy. A lot of fintech firms are trying to streamline that process and try and provide loans at a much quicker pace. And we'll see an example of that through a company called Wonga very shortly. Okay. Now, if you talk of innovations in banking, like let's say banking has existed almost from the middle of the 15th century, way back from the Medici family in Florence. That's where banking and this whole business of lending actually started. But until the 1950s, banking and financial intermediation in general was a very boring business. Products were very standard. Customers' access to financial markets was very standard and pretty ordinary. And there was some regulation, especially in the aftermath of the Great Depression. But, it was not a very vibrant market to be involved in. But what happened in the 1950s was 1950s brought about the first wave of computing. You had the advent of mainframe computers, which were finally able to process large amounts of information than before. And they were also able to store data digitally. And banks were quick to take notice of that. So what happened was with the advent of mainframe computers, banks moved on from recording transactions on paper to storing and processing transactions digitally. So that was the first advent of innovation in the banking sector. What happened in the 60s and 70s, that's many people categorize that as a second wave of banking innovation, where earlier people used to rely on cash, on paper-based money or coins to pay each other. In the 1960s and 70s, there were a new set of payment providers that emerged, like Visa and MasterCard, that began to offer cards to allow people to pay for their products and services. The advantage of using cards, obviously, as you know, is it not only reduces the need to carry large amounts of cash, but it's also a more secure way of payment, right? It improves convenience and it improves security. And many people were quick to adopt cards as a means of payment, and it became hugely popular mechanism to deal in cash. The third wave started in the 1980s and 90s, where banks, before this, banks had to operate large physical branches in order to provide the banking services. And as you know, maintaining a bank branch physically is quite an expensive affair. So if a bank has to have a branch in a particular location, it has to obviously have a building. It has to either rent or buy an office space. It has to install all the required tools and machinery, the desks and computers and whatever, in order to provide those services. And lastly, it has to maintain personnel over there to provide those services. All of these are quite expensive to deal with, and banks were looking for ways to cut costs. So in the 1980s, a number of firms came up, a number of fintech firms came up that developed this thing called the ATM, the automatic teller machine, that provided a number of benefits in the provision of banking services compared to regular physical bank branches. What was that? First of all, banks can only be open during office hours. ATMs, on the other hand, could be used, were accessible 24/7. You had access to cash in your vicinity. The space occupied by ATMs was far lesser, right, compared to a bank branch, so it could be installed in a lot more number of locations. ATMs were generally very secure. It's quite difficult to break into an ATM, so they offered safety. And lastly, they had very low operating costs compared to a bank branch. So all these benefits were quickly recognized, and banks started to open ATMs in a number of locations. And obviously, because cards were in widespread use, you could use a card like a debit card to access access banking services like cash withdrawals on an ATM. What benefit did it provide? It reduced the need for customers to travel large distances to visit a branch. And obviously, because banks were able to reduce costs, it reduced the need for maintaining that many number of bank branches. So what happened was, since the 80s, there's been a wave in the number of branches being closed. Okay. Then the fourth age of innovation in the banking sector started with the advent of the internet. So instead of having to even visit your ATM physically, which can also be quite cumbersome, especially if you're in a rural area or something like that. Now, with the advent of the internet, and let's say the widespread use of websites and mobile apps these days, you could access those same banking products and services and pay for your purchases using the internet. And so what this did was, it allowed you to conduct your banking services just from sitting on your couch. So you didn't have to really physically interact with your bank in any form whatsoever. And that has been the trend since the last 10-15 years, where I can tell you, or you can even ask yourself, how often have you visited your bank personally, right? Which in my opinion would be very little, maybe only for opening a bank account, but after that you probably have never visited your bank. All of this has been brought about by the introduction of computing and related technologies, and the increasing way with which computing has become cheaper and more accessible. Okay. Now, another important factor that has driven innovation in the banking sector and in financial intermediation in general is because of changing consumer preferences. So you have the rise of this digital consumer who today relies more on her own devices, computing devices like iPads, iPhones, or any other smart device to access most financial services. In fact, I did a check on Statista and found that more than 70% of the US population today uses a cell phone, a smartphone. Okay. What does increased usage of computing devices allow us to do? First of all, unlike the previous case where you had to visit a market in order to find out prices, Today, you can compare prices in real time and in a very quick time. So if you want to buy a shoe, for instance, on Amazon, you can browse literally through hundreds of different types of shoes in no time and make a quick purchasing decision right then and there. This was not possible when you had to physically visit a market to find out the price of a product, right? Now, what is the other advantage of using smartphones or mobile devices? The thing is, paying for your products and services has also become more and more streamlined. Today, you don't even use cards. When you purchase something on Amazon, Amazon doesn't even require to to type in your credit card number. You can make a payment using a single click. All of this has brought about greater transparency in the way financial services such as payments are dealt with. Okay? So let's take your daily schedule of a digital consumer. Now this table shows the typical activities one would normally conduct in a day, like going to a metro, buying a cup of coffee in a cafe, transferring money to friends and relatives, or finding a restaurant and having lunch and things like that, or paying for services like plumbing. You can see how dependent we have become on apps and mobile devices in order to access each of these services. So for instance, if you go to your work or you travel to university, you would normally take the bus or the metro, and for that you would use a card like a Swisscard. Or maybe you use the Swisscard app on your mobile phone to pay for the ride. How do you pay for coffee? If you go to Espresso House or Godbro, you probably pay it through a mobile app or pay for using your credit card. That's a form of innovation. How do you transfer money to your friends? You either use a service like PayPal, or if you want to transfer it across borders, across countries, you would use a service like TransferWise. What about restaurants? What do you do these days if you want to meet up friends and have dinner? You typically go to some popular apps like Foursquare or Groupon, and you find a restaurant that fits your tastes and needs of that day, right? How do you pay your plumber? A plumber comes to your home, fixes a leaking pipe. You probably use a service like Intuit, which is quite popular in the US. You probably use that service to pay the plumber then and there. The plumber probably carries a card reader, a point of sale system that allows you to transfer cash to that plumber right away. How do you order dinner? If you don't feel like cooking or traveling to a restaurant, you can order dinner through Foodora or Uber Eats, sitting in your couch. How can you buy gifts? Well, you have access to Amazon, right? What does it say? Today, most of the services we need can be delivered to us through the use of a simple app, through the use of a smart device. All of this has been enabled through a wave of innovation, not just in the financial sector, but in all walks of life. Okay? However, when you look in terms of banking, how do we access banking services in general? That has undergone significant change as well. So this is a slide I pulled off from one of McKinsey's reports a few years ago, and this shows how or through what channels we access banking services. If you look at the period before the 2000s, most of our banking services were accessed physically. So we would normally visit a bank branch to access cash, to withdraw cash, or send money to somebody, or get information on our account statement and things like that, like how much money our account held and things like that. What has happened over the years? The percentage or the rate at which we visit our bank branches has shrunk. It is only maybe 5%, and probably, and this is an estimate for 2015, probably in 2020, it has shrunk even further to less than 1%. What about our usage of ATM? Well, that has remained sort of steady at about 25%, but my guess is with the advent of banking apps, with the advent of payment services like WIPS, that has gone down even further. How do we access most of our banking services these days? Either through the internet. Well, through the internet means through a website, and most often through our phones, right? You access your bank account through your phone app. And you can clearly see that the physical need for accessing banking services has come down sharply. And that's a major trend that banks have to contend with. What about data? Earlier, banks had to rely on very limited data sources in order to resolve those information asymmetries that we have been talking about so far. But what has happened in the last few years is there's been an explosion in the amount of data that is available. Okay, whether that's in terms of data that is generated. So in the last 10 years, there's been such an explosion in data that we have about 41,000 billion exabytes of data being generated each year, okay, in the last year alone. What about data storage capacity? Our capacity to store data has also improved tremendously. It has gone up to 721 billion gigabytes. That's how much data we stored last year. What does this suggest? Banks earlier had access to very little information, maybe your credit scores, maybe some documents showing your spending history, your net worth, and things like that. But today, banks and other FIs, financial intermediaries, have access to a large amount of data that they can potentially use. But what's the problem? The data that they need to use now is huge compared to before. It's multidimensional. Like a bank can, if it wants to know, it can know who you are, what your characteristics are, where you go, how much you spend, how much time you spend at each place, what your preferences are, maybe what your moods are, and things like that. But all of this points to multidimensional data, right? And if a bank doesn't have access to that data, today it's possible to purchase that data from all the tech companies that keep track of you, like Facebook and Google, right? And the other problem is most of this data can often be unstructured and quite difficult to interpret unless the bank or an FI invests in substantial computing technologies like machine learning or data analytics in order to crunch that information and provide some meaningful inference. And lastly, today the need for financing, the request for financing, the need for access to capital has increased so much that banks not only have to process this data, they are now required to process this data at such a fast pace that enables them to make a quick decision, because that's what most new intermediaries that have emerged as a result of financial innovation are are able to do. They not only are able to process large amounts of data, but they're able to use that data and make decisions in real time. And that's something that banks are playing a catch up with. Okay. So what you've learned so far is there is a wave of financial innovation, and that's partly driven by the advent in computing, the changing consumer preferences where the consumer is increasingly becoming more digital. But another aspect is the accessibility of financial markets as well. Why do I raise this point? Now, so far we learned that capital markets play an important role in our lives. They help households save, they help firms borrow, and we learned that capital markets, financial intermediaries, so to speak, also play an important role in resolving information asymmetries, and they provide significant cost advantages in delivering that service. But my question now is, does that mean that financial markets have been accessible or allowed everyone to access the relevant services? And the answer is no. The simple answer is no. If you take firms, especially younger and smaller firms, many startups, many younger and smaller firms are called startups in general. These startups face significant financing problems, especially during their early years. Why do they face so many significant problems? First of all, they don't have a strong credit history to show a prospective bank. So getting access to bank loans is quite hard for young firms. Secondly, most startups don't have any credible assets. What does a typical startup have, especially if it's a tech company? Probably a few computers and some people working on them and some rented office space, but nothing more than that to show. How can such a company raise money from a bank if it has no collateral to provide? Third thing is, most startups are bound to fail. If you look at VC literature, venture capital literature, you'll note that 9 out of 10 startups are generally tend to fail. So many young companies are actually quite risky propositions. So given their higher risk inherent in them, it's quite difficult for many startups to raise money, especially from traditional financial intermediaries. So what do most startups can have to do in order to raise money? Well, they are forced to turn to venture capital investors or other markets, which are not only more demanding, but money raised from these other markets comes with many more significant restrictions, many more terms and conditions. So if a VC provides money to a startup, normally a VC would require an ownership stake in the firm that he or she is investing. A bank, on the other hand, when it provides a loan, doesn't require an ownership stake in your firm. A VC will also control where you spend your money as an entrepreneur. A bank doesn't necessarily exercise that kind of control. And so the point here is financial markets have generally been inaccessible to most young startups. What about firms? What about individuals and households? Well, we live in a very developed banking system, and so most of us can access and open a bank account and also access banking services. But what about people living in developing countries? Many people living in these countries, like in Asia, in Africa, and in South America, don't have access to regular banking services. Whether that's for saving the money, whether that's for raising loans, or whether that's for accessing insurance products. Many of them don't have access to those services. If you take farmers in India, most of them don't even have a bank account, and they cannot even access proper crop insurance to protect their farms. If, let's say, there is a big cyclone and their crop goes bust, there's nothing much they can do. And the reason is because they don't have access to formal insurance products. What happens as a result? Because these people don't have access to formal banking channels, they are in turn forced to rely on shadow credit markets, these loan sharks. What are loan sharks? Well, loan sharks are people who lend money to people in need, but they don't face any kind of regulation. They operate in an informal manner. What happens as a result? These loan sharks try to squeeze as much as possible from these people who are already vulnerable. So many farmers end up taking loans from these loan sharks, and obviously because these guys are outside of regulation, they tend to charge high interest rates. Sometimes the loan contracts are also dodgy because many farmers cannot read and write. So these loan sharks take advantage of that issue, and they include terms and conditions that force these farmers into some sort of a debt trap. So what happens? These farmers raise loans at very high interest rates. They become unable to repay, and they are forced to refinance. They are forced to raise more loans that pushes them deeper and deeper into a debt trap. And ultimately, they reach a position where they are not in a position to. They end up not being in a position to repay their loans, and not even in a position to not in a position to feed their families. So what happens? Many farmers have committed suicide as a result. So the point here is financial markets have also not been accessible to everybody, and that in itself has spurred a new wave of financial innovation. Now, in general, fintech can be categorized into two forms. One is this notion called reintermediation. So what does reintermediation seek to achieve? Reintermediation refers to the emergence of new intermediaries that are better able to transact, that are better able to provide financial services and products. The most notable thing about reintermediation is these new intermediaries that emerge as a result are able to create new markets altogether. They don't seek to displace existing intermediaries, but instead create a new market in their own way. What happens with the existing intermediaries? The existing intermediaries are either forced to adopt a similar business model like these new ones, or in most cases, these existing intermediaries partner with these new guys, and as a result, they themselves become better managed. They become better at providing their own services and products, and also become more efficient at what they do. So take the example of Amazon. Now, Amazon is not strictly a financial intermediary, but I thought it's a good example to include here. What is Amazon? Well, it calls itself a technology company, and it was established in 1994 by Jeff Bezos, right? Most of you probably know who he is, and most of you know Amazon. What did Amazon achieve? Well, it simply created an online platform. It was an early innovator on the internet domain, and what it did was it created this e-business platform that allowed people to buy books and other products online rather than go to a store physically and buy that stuff. Over time, it became so popular that Amazon was able to quickly build a large customer base. Many people who would normally not visit a bookstore either became new customers, and many people who would normally visit a bookstore increasingly started to rely on Amazon for their purchases. They started to buy books on Amazon. So on one hand, Amazon was creating a new market in its own way by attracting more number of users, more number of customers. And at the same time, it was also partially poaching a lot of customers from existing retailers, existing publishers, and existing manufacturers and things like that. So how did retailers react? How did these manufacturers react? Many retailers either went bankrupt because they just didn't adapt. Whereas many other retailers, on the other hand, they simply partnered with Amazon. Instead of selling directly through having physical stores, they opted to sell their books, they opted to sell their products on Amazon. Obviously, they had to pay a fee to Amazon for doing that, for being able to do that, but both benefited ultimately. And what happened today? Amazon re-intermediated this whole notion of a marketplace. It established something called the online marketplace, and today it's the world's largest online market, with a market cap close to $1 trillion. Right? Now, within the financial sector, there's been a wave of re-intermediation. So let's take this example of a bank called Simple. So Simple, it used to be called Bank Simple earlier. Now Simple is a bank in its own way. Okay, it's a bank ultimately, but it's a new form of bank. How is it new? Unlike a traditional bank that has physical branches, that has a headquarters, and that provides some of the regular services like loans and keeps deposits, Simple operates under a much more simpler business model. First of all, it maintains no physical presence. It has no bank branches. It has no physical offices. So you can't go to a Simple branch, okay, to access banking. All of Simple's operations are conducted online. And how do customers benefit from that? Well, for starters, when customers open a bank account with Simple, they get a bank account, obviously, and they get a debit card. Now, apart from the regular banking services that any of these other banks like US Bank or Chase could provide, Simple also provides an integrated set of budgeting and savings tools. So what that allows customers to do is not only have a bank account, but also keep a track of their daily and personal expenses. So it allows customers to benefit from access to these additional tools. Now, because Simple does not have any bank branches, it has no physical presence, it is able to keep costs at such a low level that customers can access any ATM or any other banking service for almost free. Okay, so on one hand, customers are able to benefit from access to virtually free banking services. Now, what about the other side? When customers put their money in the form of deposits, Simple doesn't keep any of that money. Instead, what Simple has done is, rather than compete directly with these traditional banks, it has partnered with them. And by partnering with them, Simple is able to keep those deposits with its partner banks. And also the cards are issued by these partner banks themselves. So Simple is acting as an intermediary to these existing intermediaries. Okay? How do the traditional banks benefit from this re-intermediation? Now, because Simple is able to keep operating costs at a minimum, banks here are able to access a new base of customers people who would normally not open a bank account with these traditional ones. Secondly, they are able to offer loans at much competitive rates, at very cheap rates compared to what they would offer normally. And therefore, they are able to attract a new set of borrowers who would normally not be interested in taking a bank loan. So the ultimate story here is, because of reintermediation, these traditional banks are able to offer loans at much more competitive rates through Simple. And obviously, Simple also benefits because all the repayments that are made are shared between Simple and these partner banks. So what has happened here? These traditional banks haven't gone away, but they're able to offer more efficient services, more cheaper services through Simple, through this reintermediating firm, to not only existing customers, but they're also able to attract a new base of customers, maybe young people, okay, who would normally not open a bank until they reach their 30s. What is the drawback of this model? Well, because Simple offers most of its services at virtually free rates, it doesn't offer much return on deposits. We discussed last time that banks generally offer, at least these days, they offer deposits at very low interest rates, which are close to like 0.1%. Well, an account holder on Simple doesn't earn any interest rate whatsoever on her deposit. These are very low. So that's the only major drawback of this model. But ultimately, the point I'm trying to make here is, by partnering with traditional banks and having no physical presence, Simple is able to offer a banking service at zero cost. The deposits are kept with the partner banks, meaning they are secured, they have government insurance, and Simple is able to provide the same set of services at very low cost and probably in a more efficient manner. Okay, and that's an example of reintermediation. There's also another form of fintech that is active in the last 15-20 years, and that's called disintermediation. So what does disintermediation seek to do? Unlike the earlier case where the idea was to work with existing intermediaries and probably create new markets, disintermediation is more extreme in what it seeks out to do. It simply seeks to placate, it simply seeks to replace an existing intermediary by cutting them out. So disintermediation is popularly known as cutting out the middleman. How is disintermediation generally achieved? Disintermediation is possible with access to cheaper computing power, access to cheaper storage technologies, and also due to access to faster communication. Okay, all of these have spurred the emergence of new digital platforms that are seeking to replace the existing financial intermediaries. An example is crowdfunding. We'll see an example of crowdfunding through which is P2P, peer-to-peer lending. But more recently, we also have the emergence of blockchain technologies. What are these trying to do? Blockchain technologies also seek to replace existing banks because of various reasons, but the ultimate objective is to disintermediate the capital market. So how does a digital platform seek to disintermediate? Well, it just seeks to match investors and borrowers, or capital seekers and capital providers, without having to deal or without having to match each of them through an intermediary like a bank. So instead, what a digital platform seeks to achieve is allow the investor and the borrower to interact directly, search each other directly, and match on their own without having to go through a banking intermediary. Right? So let's take an example in this context. So normally, if you wanted to access a loan, if you wanted to raise a loan, you would go to a bank, right? A traditional bank like DNB, and seek loan for whatever purpose you need the loan for. Now the problem is, a bank like DNB would not be willing to lend me money for very short-term purposes. Like if let's say my salary is due next month, but I don't have any money right now, even if I go to DNB, I might not be able to raise a short-term loan that will be able to serve my financing needs for this interim month. And many banks don't provide short-term loans especially for individual customers. So this is a very underserved market that many banks have not dealt with. So what many fintech firms have done is they have recognized this big gap existing within loan markets, and so they came up with new solutions that seek to resolve some of those inefficiencies. So for example, I have used the example of a firm called Wonga. So Wonga is an international provider of payday loans. So what are payday loans? These are generally short-term loans, unsecured, meaning the borrower doesn't have to provide collateral. These are provided for very small purposes. Like if you need to, if you don't have enough savings, if you're waiting for your salary, let's say for the next 1 month, and you don't have any savings left, you can go to Wonga and try to raise money for a very short period, maybe a few days. So let me take the example of this website. So if you take the case of Wonga here, how can I access a loan at Wonga? So I just go to their website, and Wonga on its main page says I can raise a loan of up to 4,000 South African Rand. So R here means Rand, and it says to be able to raise up to 4,000 South African Rand, which is about $185. I'll need 4 things. One is I'll need a valid cell phone number. Then I need a South African ID, because this website caters to the South African market. I need to provide details of my bank account. And lastly, I need to show some proof of income. Obviously, even a platform like Wonga would be interested in knowing my credit worthiness, whether I'm in a position to generate enough cash flows, whether I'm really expecting to get a salary that I can use to repay my loan. How do I raise a loan on Wonga? Now, if you wanted to raise money from a bank like DNB, you would have to physically visit their branch, possibly talk to a loan officer, provide some paperwork, and wait for a few weeks to get that loan. What about Wonga? Well, here, all I have to do is go to the website, specify how much I need. So here I use the slider here to say I need a loan of 3,000 South African Rand. Then I use the second slider and say how long I need the loan for. So here Wonga issues loans for as low as 4 days, but let's say I need a loan for up to 4 months. Okay, meaning my loan duration is for 4 months. Right? The third part is I need to specify when I'll pay my repayment, when I'll repay the loan each month. So let's say I choose to repay on the 31st of every month. Once I input my requirements as a potential borrower, what Wonga does is it gives me 2 pieces of information. One is it says how much I'm expected to pay each month. So it says I need to pay 4 installments because my loan period is for 4 months, and each installment I have to make is about 1,000 Rand. Second part is it also gives me a breakup of how much I pay in terms of fees and interest. So if I raise a loan of 3,000 South African Rand, it says that in total I'll be repaying about 4,000 South African Rand. So almost 1,000 extra in the form of service fees and also interest. Okay. Now that's it. All I have to do is provide these 4 details, give my requirements, and just apply. What is Wonga achieving here? Well, first of all, it is serving an underserved market. It is providing loans for short-term unsecured purposes for small amounts, very small amounts, up to £200. It doesn't have any physical branches, so all applications need to be made online. And the interesting part is credit can be accessed instantly. So loans are issued very quickly. And in fact, the money is transferred to the borrower's bank account in less than 15 minutes. Which bank in the world, which traditional bank in the world gives you a loan that quickly? And loans are also given out for short periods. So the maximum borrowing term is about 6 months. So what is happening here? It has an online only presence. The borrowing decision here. So the interest rate that is being shown here to me, okay, this part, all these computations are not being done by a human being. What Wonga has done is it has put in place a fully automated platform and the lending decision is made by that fully automated platform on preset rules, right? And obviously, much like any other financial intermediary, much like any other bank, Wonga also encourages early repayment. So if I'm a good borrower who's timely on my payments and I'm repaying my loan quickly, Wonga rewards me by allowing me to raise twice as much when I seek an additional loan, and it also gives me a more cheaper interest rate. How does Wonga make money through this setup? First of all, Wonga has access to my debit card, so it can get my repayments directly by tapping into my debit card. So it doesn't need any kind of authorization from me because I will already have given that authorization as part of my loan application process. Secondly, it gets repaid in the form of interest rate. Plus, it also charges some penalties if the borrower is late on her repayments or if she defaults on her loan. All right. But what is the problem here? Look at the split up of these charges. So for borrowing 3,000 Rand, I'm expected to pay about 1,000 Rand extra. So what is the interesting feature here? My loans are carrying very high interest rates. Now obviously Wonga says some of this is in terms of service fee, but the service fee is also quite high. For a 3,000 Rand loan, the service fee is close to 10%. No bank will charge you that high of an interest rate, service fee, sorry. And the interest rate charged is also higher. So if you combine the excess amount that you pay on top of this loan amount, the estimated annual interest rate is about close to 160%. Now, even a bank, when it provides a traditional loan, the highest interest rate it would charge to the most riskiest borrowers would generally be in the range of 15%. So what you see here is a platform like Wonga, which is trying to disintermediate the loan market by providing short-term unsecured loans, is charging very high interest rates. In fact, 10 times more than a normal bank would charge to the highest, let's say the most riskiest borrower. What does this suggest? These guys are trying to serve an underserved market, but they're also indulging in highly predatory practices. But wasn't the purpose of financial intermediation to drive down the cost of financing? Or drive down the cost of intermediation? Well, when I look at examples like these, it doesn't seem to be the case, right? And in fact, Wonga has faced a lot of criticism. It has been accused of threatening borrowers, issuing them threatening letters if they are late on their payments. It has also faced disciplinary action from regulatory authorities in the UK. And in fact, Wonga's UK branch was forced to close in 2018, right? So the point here is, just like in the last lecture where we saw that securitization was a form of financial intermediation that had a lot of benefits for banks, but it also had a lot of issues that threatened the very viability of the financial system. We see something similar happening here, where a number of these new intermediaries that are seeking to provide better services are in fact employing more predatory practices. They are trying to exploit their customers. I'm not saying this is widespread, but there are a lot of these new intermediaries out there that call themselves as fintech platforms that are actually exploiting customers. And one of the reasons why they're able to do this is because, unlike banks which are subject to heavy regulation, peer-to-peer fintech platforms actually face less scrutiny from regulators. So that's and obviously take advantage of that lax scrutiny. Okay, so this concludes the first part of our lecture. In part 2, we'll be focusing on peer-to-peer lending, and we'll try to understand what this exactly is. All right, thank you for your time.